Imagine waking up tomorrow, opening your brokerage app, and seeing every position gone. No stocks, no ETFs, no cash cushion, just a big, ugly zero staring back at you. Most people would melt down in that moment. Panic, regret, maybe even shame. Years of saving and investing wiped out overnight feels like watching your future disappear in real time. But if I had to rebuild from nothing, I would not chase the hottest stock, the newest coin, or the loudest headline. I would rebuild with a simple, boring plan I fully understand. In fact, if I had to start over today, I would still use only 3 ETFs. One for broad growth, one for dividends, and one for pure innovation. That's it. My name is Dave, this is Dave's Dividend Lab, and here we turn small, consistent dollars into serious long-term wealth. If that sounds like your thing, hit subscribe, like this video, and drop a hello in the comments. Today, I want you to picture something uncomfortable but powerful. Not losing everything, but starting as if you had. Fresh slate, no emotional baggage, no complicated positions, only a clear plan to build wealth again. The truth is, wealth rarely comes from being clever in one lucky moment. It usually comes from being consistent when nobody is watching. Quiet contributions, month after month, year after year. The problem is that most people secretly hate simplicity. They want fireworks, not a furnace. They jump from stock to stock, strategy to strategy, chasing excitement and hoping it somehow adds up to financial freedom. I believe the opposite. The more boring my investing feels, the better I usually sleep. And after years of learning, failing, and improving, my philosophy fits in one sentence. You do not need 20 ETFs, 100 stocks, or constant predictions. You need a structure that keeps working, even when you are tired, distracted, or scared. That is where these 3 ETFs enter the picture. Together, they cover broad market growth, a stream of dividends, and exposure to cutting-edge innovation. 3 different roles, one simple system. Before we talk about them, let's quickly demystify what an ETF actually is, because if you understand this piece, the entire plan becomes much easier to follow. An ETF, or exchange-traded fund, is basically a basket of investments wrapped into one share. Instead of buying dozens of individual companies, you buy one ticker that already holds many inside. Think of it like a grocery cart that someone carefully filled for you. Instead of picking every item alone and worrying about balance, you grab the cart that already follows a clear recipe. The first huge advantage is diversification. If one company inside the basket has a terrible year, others can offset it. Your future does not depend on a single hero stock behaving perfectly. The second advantage is cost. Many ETFs charge extremely low annual fees compared to traditional managed funds. That tiny percentage difference might look harmless today, but it snowballs massively over 30 or 40 years. The third advantage is simplicity of trading. ETFs move throughout the day like regular stocks. You can buy or sell with a click, build positions gradually, and reinvest dividends without dealing with complex structures. Maybe the biggest hidden advantage, though, is psychological. When you own baskets instead of individual names, you are less tempted to constantly obsess over each company's daily drama. Instead of waking up wondering what a single stock will do, you focus on adding to your baskets and letting the underlying businesses work. Less noise, fewer impulsive decisions, more compounding. Now, not every ETF deserves a place in a serious long-term portfolio. There are thousands of products. Some are thoughtful, others are just marketing. So we need clear selection rules. For this 3 ETF setup, I want funds that check a few boxes. Very low fees, strong trading volume, a clear, transparent index, and a history that shows they behave as expected. We also want each ETF to play a different role. One should give you exposure to a very broad slice of the stock market. One should focus on reliable dividends. One should lean into higher growth innovation. And just to be crystal clear, everything here is education, not personal advice. You are responsible for your own decisions. My goal is to show a framework you can study, stress test, and adapt. Let's start with the backbone of this portfolio, the broad market ETF. This is the fund that quietly owns hundreds, sometimes thousands, of companies across many sectors at once. When I think of that role, I think of something like VTI, a total market ETF. One ticker. Exposure to a huge range of businesses, from giants everyone knows to smaller companies growing in the background. The job of a total market ETF is simple. It mirrors the overall stock market. If the market grows over decades, your slice grows with it. You are not betting on one industry or a handful of favorite names. Historically, broad equity markets have rewarded patient investors with solid long-term returns, despite crashes, recessions, inflation scares, and every scary headline imaginable along the way. VTI also shines on costs. Total market ETFs are famous for charging very low fees. Over a single year, the difference looks tiny. Over a lifetime, it can be hundreds of thousands of dollars saved. Think of VTI as the foundation of a house. You can decorate the rooms later, but if the foundation is weak, nothing else matters. This fund gives you that underlying strength and stability. Now imagine pairing that foundation with a second ETF designed for one main mission, sending you cash. Not once, but over and over again, ideally growing those payments year after year. That is where a high-quality dividend ETF comes in. One of my favorites in that category is SCHD, a fund built around companies with strong, consistent dividend histories. SCHD focuses on businesses that not only pay dividends, but also have the financial health to keep paying and hopefully increase those payouts over time. Think solid cash flows and sensible balance sheets. The beauty of a dividend ETF is that you are not just watching numbers on a screen. You are receiving real income deposited into your account, which you can either spend or reinvest. When you are in the building phase, reinvesting those distributions is incredibly powerful. Every time you roll those payments back into more shares, you increase the number of future payments automatically. It is like planting trees that drop seeds, which grow into more trees. At first, the forest looks tiny. But after many seasons of reinvesting, the landscape starts to change dramatically. Another key advantage of SCHD's style is temperament. These kinds of companies tend to be more established, with durable business models. They might not be the flashiest names, but they are dependable workhorses. Now that does not mean a dividend ETF never falls. It absolutely does. But receiving consistent cash flows during rough markets can make it emotionally easier to stay invested and avoid panic selling. At this point, we have two pillars: VTI for broad market growth, SCHD for dividend income, and a bit of extra stability. Together, they already build a strong core for many long-term investors. But I like adding a third piece to this puzzle, a fund that leans heavily into innovation, technology, and sectors pushing the world forward. Something designed for higher potential growth, with higher volatility attached. That is where an ETF like QQQ enters the picture. It tracks a basket of large, non-financial companies listed on a major technology-heavy exchange, with a strong tilt toward innovators and disruptors. Inside a fund like QQQ, you typically find leaders in software, chips, cloud infrastructure, digital advertising, and other areas that have transformed how we live and work in the last few decades. These businesses are not guaranteed winners, of course, but many operate with high margins, strong network effects, and massive global reach. When they succeed, shareholders can be rewarded very handsomely. The catch is volatility. An innovation-heavy ETF can drop much faster than the broad market during panics. Prices can swing dramatically in both directions, testing your patience and discipline. That is why I treat QQQ as the spicy part of the plate, not the entire meal. Enough to move the needle on growth, not so much that a bad year keeps you awake every night. So now we have our three roles clearly defined: VTI for broad diversification, SCHD for a growing stream of dividends, QQQ for concentrated exposure to innovation and higher growth potential. Together, they form what I call a three-engine portfolio. One engine pulls steadily, one feeds you income, one gives you bursts of acceleration. Each has strengths that complement the others. When broad markets struggle, dividends from SCHD can soften the blow. When mature companies move sideways, innovation inside QQ can surprise on the upside. When tech sells off, total market exposure keeps you grounded. The magic, though, does not come from simply owning these tickers. It comes from how you fund them over time. Because the real secret weapon in this entire plan is not stock picking, it is contribution habits. This is where regular investing, sometimes called dollar cost averaging, becomes your superpower. Instead of guessing the perfect day to buy, you commit to investing a fixed amount on a regular schedule. Some months prices will be high. Other months, they will be lower. Over time, this rhythm naturally buys more shares when they are cheap and fewer when they are expensive, without any emotional debate. Now, let's put some numbers to this idea, just as a thought experiment. Imagine someone starts with a modest account and adds a set amount each year for several decades. The exact return they earn will depend on markets, of course. But historically, a well-diversified mix of broad market, dividends, and growth has delivered meaningful results for patient investors. With regular contributions, low fees, and reinvested dividends, the dollars you add in your 30s can still be working for you in your 60s, quietly compounding behind the scenes. Here is the part that many people underestimate. The difference between investing consistently and waiting for the perfect moment often adds up to a gap of hundreds of thousands, sometimes millions, over a lifetime. Timing feels exciting. Consistency feels boring. Yet boring usually wins. The 3 ETF framework leans into that boring strength while still giving you enough growth potential to keep things interesting. Now, how do you decide how much to allocate to each ETF? That is where your age, risk tolerance, and goals enter the conversation. Let's walk through 3 simplified stages. Stage 1 is the aggressive growth phase. This is typically when you have a long runway ahead, decades before needing the money, and a stable income feeding your contributions. In that phase, it can make sense to tilt more heavily toward growth and innovation. VTI still forms the base, but QQQ might receive a larger slice since you have time to ride out volatility. SCHD still plays a role, but mostly as a smaller portion, quietly sending dividends that you reinvest back into the mix. Those little payments buy more shares automatically, even during market turbulence. Stage 2 is the balance phase. Here you might be in your middle career years, with a meaningful portfolio already built and a growing desire to protect what you have while still growing it. If this is you, tap like and comment. In that situation, you might shift toward a more even mix. VTI and SCHD could share the spotlight, with QQQ still present, but as a smaller turbocharger rather than the main driver. This balanced approach aims to blend respectable growth, real dividend income, and some exposure to innovation without letting any single risk factor dominate your financial future. Stage 3 is the harvest phase. You are getting closer to relying on your investments to cover bills, experiences, and peace of mind. Capital preservation and reliable cash flows become much more important. Here, SCHD can take a leading role, providing a steady stream of dividends. VTI continues delivering broad market exposure and potential growth. QQQ, if present, usually shrinks to a relatively small slice. Notice something important. We never needed to abandon the framework. We simply tilt the weights as life changes. The tickers stay the same, but their roles shift with your priorities. Once a year, you can check your allocations and rebalance. If one ETF has grown far beyond its target percentage, you trim a little and redirect into the others, keeping your risk aligned with your plan. This process forces you to do something emotionally difficult but mathematically sound, selling a bit of what outperformed and buying what underperformed, instead of chasing whatever just went up. But let's address the elephant in the room. Crashes, bear markets, those ugly years when everything seems red and every headline screams that this time is different and the world is ending. In those moments, your biggest enemy is not VTI, SCHD, or QQQ. Your biggest enemy is your own reaction. Selling everything at the bottom turns temporary declines into permanent losses. A well-designed 3 ETF portfolio does not prevent downturns. Nothing does. But it gives you a simple, understandable structure you can lean on when fear is loud and patience is quiet. Receiving dividends from SCHD during rough periods reminds you that businesses are still operating, still sending cash. Watching VTI represent thousands of companies helps you see beyond a single sector, and understanding that QQQ will swing harder than the rest prepares you to expect turbulence instead of being surprised by it. Volatility becomes a feature, not a fatal flaw. Of course, there are ways to sabotage this entire plan. Constantly switching ETFs, chasing the latest thematic product, or abandoning contributions every time markets dip can all destroy long-term results. Overusing leverage, borrowing heavily to buy more shares, can also turn a reasonable plan into a fragile one. A 3 ETF strategy only works if you let time and compounding do their job. Think of yourself less like a trader moving pieces every day and more like the owner of a giant invisible business empire. Your 3 ETFs are just different windows into that empire. VTI shows you the big diversified machine. SCHD shows you the factories that send you steady cash. QQQ shows you the research labs and innovators trying to build the next big thing. When you think like an owner, temporary price moves become less scary. You focus on whether the underlying businesses continue producing products, services, cash flows, and innovation. To make this more concrete, imagine a fictional investor starting small. Maybe they automate contributions every month into these 3 ETFs, ignore day-to-day noise, and simply rebalance once a year. They experience a few nasty bear markets along the way. Their account value drops sharply more than once. But instead of quitting, they keep contributing, reinvesting dividends, and trusting their rules. 20 or 30 years later, they look back and realize something surprising. The exact months they invested mattered far less than the fact that they never stopped investing. That is the real story behind many seemingly impressive portfolios. Not secret strategies, not perfect timing, just a simple structure followed relentlessly through good and bad seasons. Let's quickly recap the framework so it stays fresh in your mind. 3 roles, 3 ETFs, 1 plan. Broad market growth through VTI. Dividend income and stability through SCHD. Innovation and higher growth potential through QQQ. Layer regular contributions on top. Reinvest dividends whenever it fits your situation. Rebalance periodically. And most importantly, make decisions based on your written plan, not on breaking news. If you are still watching, take a second to like this video, subscribe to Dave's Dividend Lab, and comment which of these 3 roles is currently strongest in your own portfolio. Maybe you already own a broad market ETF but have not added a dividend component yet. Maybe you are heavy on tech and light on cash flow. Use the comments to think that through. Remember, you do not have to copy anyone's exact tickers or percentages. The real value is understanding why each role exists and then designing your own version that matches your life. When you sketch your own version of this plan, think about your income stability, emergency savings, and comfort with seeing numbers move up and down. The safest portfolio on paper still fails if you cannot emotionally stick with it. It also helps to write your rules somewhere visible. How much you will invest, which ETFs you use, how often you rebalance, and under what circumstances you will absolutely not sell. Clarity now protects you from future panic. Remember that taxes, regulations, and account types differ between countries and even brokers. Before acting, make sure you understand how dividends, capital gains, and contributions are treated where you live and invest. If you feel stuck choosing percentages, start extremely simple. Maybe equal thirds between the 3 ETFs, then adjust slowly as you learn more about your own reactions to volatility, income, and market swings over a few years. And finally, give yourself permission to be imperfect. You will never design the perfect allocation or buy at the perfect moment. What matters is that you begin, continue, and keep improving your system as life evolves around you. If you want to go deeper, check out the other videos here on Dave's Dividend Lab, especially the ones where we break down dividend strategies and long-term compounding in more detail. I appreciate you spending your time here today. Let me know your questions in the comments. Tell me which ETF you would keep if you could only choose one, and I will see you in the next video.